What's up, you guys? Thanks so much for joining me today. It's your boy, the Finance Bro, and in this video, we're going to be taking a look at shares of HIMS and HERS, see if shares are trading overvalued, undervalued, or fair valued as of market close on April 24th, 2026. And as always, this video is not investment or financial advice and is solely for entertainment purposes. Let's dive right in here. You can see the past 12-month price chart for HIMS and HERS. Over the past 1 year, shareholders received an 8.6% return, comparing that to the benchmark that returned a 30.2% share return over that same time frame. That is a relative underperformance of negative 21.6% on shares of HIMS and HERS relative to its benchmark. You can see there in the top graph is the share price as well. Shares are trading in between their 50 and 200-day moving averages, and the 50-day moving average is still trading below the 200-day moving average. That's that line in the orange. You can also see that shares are still off their 52-week high by almost 50%, and they have had a peak to trough decline of 75% over that time frame. I also want to point your attention to the bottom left here. That's the 14 analysts that cover the name. They have an average target price of $26.74. That does imply a 12.5% share decline over that time frame if shares hit their average target price on these 14 analysts. We'll dive into that in the next snippet here, but the EPS at the bottom left, you can see the 25 to 26 EPS growth is declining from 51 to 50 cents per share, and the projected EPS growth in 2027 will actually make the EPS its highest it's ever been in the company's history. They do have lofty goals and projections, so let's see if they're able to execute on their plans and reach those targets. You can see that sales have grown almost 60%, 59% over the past 12 months, a 10-year trend in the positive, and you did see an explosive growth post-COVID and really post-2022. A lot of pharma companies, a lot of online healthcare providers did see an explosion over that time frame, and HIMS and HERS was also caught up in that, having a significant market share already in that space and also being one of the first movers and having that first mover advantage. And you can see the profitability chart there. The gross margins of almost 61% is phenomenal. They do operate on high gross margins, but you can see that from that gross to net margin, a significant decline from almost 61% gross margin to net margin of 5.5%. You can see that it actually increased over the past couple of years in that 10-year trend graph. Now, HIMS and HERS aggressively invested in marketing and marketing campaigns to get out there, to get their name out there, and have that brand recognition to draw new customers through sort of like the red car effect. If you see HIMS and HERS more often, you see those commercials, you see those ads online, then when a time comes to use some of those products, buy some of their products online, any GLP-1s, any hair loss treatment, those are the two biggest segments of HIMS and HERS revenue basis. If you're looking for those types of products, the first company that HIMS and HERS wants you to think of is themselves, and they believed heavily investing in advertising was going to pay dividends, and in a sense it has with that explosion in sales growth. But margins are a real issue for this company, and it's inevitable that, you know what, you can have those beautiful revenue and sales growth, but if you don't have the margin, you don't have the profitability long term, you're either going to burn cash or you're going to file for bankruptcy. And you look at the valuation there, both the forward PE and the trailing PE are very close to 60. That is actually quite overvalued for the shares, especially when you look at those analysts. There's a share decline. They're not having great margins, and they are losing market share to other providers globally, and we'll see that in next snippets. But even the price of sales, you can see that it's lower than the industry, but higher than the benchmark, almost double the benchmark, I want to say, in that case. And the market's actually doesn't even believe that there's going to be the same amount of growth as it has had in the future, in the past, I should say, sorry. And we'll touch on that later on in the snippets at the end, but the market doesn't really believe in HIMS and HERS plans for its future. And you can look at those analysts there. Like I was saying, you're seeing a 12.5% average decline in shares from those 14 analysts. Actually, the biggest bull has only a $35 price target. That does imply a 14.5% return, whereas the biggest bear has almost the shares. Mind you, they're already off 50% from their 52-week high. This bear believes that shares can drop by almost half once again. And the risk reward really isn't there. 14.5% on the biggest bull, and the biggest bear is losing half. So that risk reward doesn't really add up, in my opinion. And you can see there in that graph above that dotted line, which is the analyst target prices, and the blue line, which is the share price of HIMS and HERS. Shares have traded above their price targets, acting as a floor. There's a lot of retail interest in here. And the shares just recently started to trade above the analyst price targets. That is because of that deal at the end of March with Novo Nordisk that we'll touch on later on in the video. But retail investors have really pushed up the stock, and analysts have not really pushed up their price targets. So that is quite indicative of how the big money sees HIMS and HERS. And respectfully, you can have all the retail interest in the world. If you don't have those institutional fund flows, well, your stock can stay stagnant, especially if you don't have either great margins, great future profitability, great future projections in your sales and revenue that you can convert to profitability, and so forth. And right now, analysts don't really see that for HIMS and HERS in its future. And you can see those margins have increased, but everything else has significantly declined. I want to mention the return on assets, equity, total capital, and invested capital. Now, like I was mentioning, in 22 all the way through 2023, they were investing heavily in marketing campaigns, and that return on those marketing campaigns is quite lackluster. You look at that return on invested capital in December of 2025 of just 12%. Mind you, people will say this is a healthcare company. This is a technology company that sells healthcare products. It is operating on, in a sense, a subscription basis. And have that 12% return on invested capital when you have other big tech names having that in the 50, 60, 80% range in some cases, I don't see why investors would want to put capital towards this name. The revenue per employee has increased over the years, but again, that is just due to the explosion in revenue from HIMS and HERS and the total telehealth sector as a whole. And you can see those sales really booming, and you see that sales on a 5-year compounded annual growth rate of 205.3%. That's great. I have to give it to them, and I have to tip my hat to HIMS and HERS. But at the end of the day, you're looking at these EPS numbers, you're looking at the margins, and this new partnership that they're in with Novo Nordisk that the market is very bullish on. I personally do believe that it'll compress margins, and not just myself, but big money also believes that as well. Again, we'll touch on that later on. But I want to mention here the use of cash for HIMS and HERS. What's nice to see is share repurchases really growing through 24 and 25. I want to mention also this is a double-edged sword, especially if they're buying a lot and you see a big chunk in 2024, almost the same amount in 2025. And if they're buying at these highs and they're confident in the underlying business, we do want to see companies and executives and management teams buying into the company shares. But if they're buying at a high and the company's allocating this cash that's on their balance sheet and they're suffering those losses, again, 75% peak to trough declines from its 52-week high to its trough, yet shares as of market close on April 24th, 2026 are actually trading almost half of what they were this time last year. So that is a huge cash burn on the balance sheet. And I just want to mention the revenue segment per country. You're seeing declines in the US. You are seeing slight upticks globally, but market is becoming very saturated, and there's other competitors. You look at Canada, for example, that has Rocky.ca that is already grabbing market share from HIMS and HERS. So an international growth story isn't really in the cards for HIMS and HERS long term. Now, like we saw in the previous slides there, the company has seen explosive growth over the past few years, but there's several critical red flags that I do want to touch on that dominate the bearish narrative. The bears right now are outweighing the bulls on the name, and you are seeing that in the pressure on shares. And the first point I want to touch on is the GLP-1 legal cases that HIMS and HERS had to deal with. And the most notable one is Novo Nordisk, who recently filed a lawsuit last year against HIMS and HERS for patent infringement and alleging illegal mass compounding of its blockbuster drug, Wegovy. Now, they did enter into a partnership where HIMS and HERS will pay Novo Nordisk to sell Wegovy on the platform, not the knockoff version. But if they're paying Novo Nordisk these, in a sense, fees, they are already compressing margins on a very narrow margin business to begin with when we look at net margins. So investors long term do actually feel this will be a margin compression story, not a margin expansion story with this Novo Nordisk partnership. Again, time will tell. HIMS has received a letter from the SEC's Division of Enforcement regarding its public disclosures of certain items. Additionally, the DOJ has reportedly looked into potential food violations and other cosmetic violations that are part of the Federal Food, Drug, and Cosmetic Act. So let's see how those pan out. And under regulatory pressure, HIMS was actually forced to withdraw its copycat version of that obesity pill. So they're no longer able to sell that. And that was actually a high margin segment of HIMS and HERS. Again, they are now able to sell Wegovy, the branded version of this product of the weight loss GLP. And it's not a pill, that's an injection. But that was a good margin for them. Let's see how this structure with Novo pans out long term. But right now, investors don't really see the potential of this expanding margins long term. And analysts at firms, I want to point out Morgan Stanley, for example, has projected growth to slow to approximately 17% for 2026. Now, 17% is good for companies, don't get me wrong, but that's a massive drop off from the 111% year over year growth it had in its most recent quarter. So again, that revenue slowdown is because of the market becoming more saturated when they expand into these international markets. I'll use Canada, for example, with Rocky.ca. They're no longer the only player in the game, and they're having to share that space. And it's a very narrow margin business, like we saw. And if they want to compete to gain more market share in these international regions, then they're going to have to be competitive on pricing. And I personally don't believe they have the flexibility to have those really competitive pricings in certain markets. Recent earnings reports missed revenue guidance, and guidance for the first half of 2026 was softer than the market anticipating, leading to those multiple market analyst downgrades. I want to mention the Amazon effect here. Like we've been saying, they're not the only convenient player in the game. Amazon itself, through its health division, is unveiling a competing weight loss and telehealth program actually this month. Directly threatens HIMS and HERS market share and pricing power when you have such a juggernaut of Amazon coming into the space with Amazon Health. HIMS, I personally don't believe we'll be able to compete if people are already purchasing products, everyday products on Amazon to begin with. And this Amazon Health offering is there to them. And for its Prime members, then it's only making sense through Amazon's stickiness of its customers returning to the platform and being reoccurring customers that they will only continue to use the additional segment of Amazon Health, which will take away segments from them as well. Like I said, in Canada with myrocky.ca. And there are European competitors to HIMS as well. Also, as more digital pharmacies enter the space, the cost of acquiring customers is expected to rise. Again, this will be compressing margins. And as you can see, there is a common narrative here with the margin pressure and also the investment risks. The company is actually spending heavily on technology and supply chain verticalization and its international expansion. In fact, the biggest international investment for HIMS and HERS has actually been into Canada. And again, there are several providers already in that nation that have had that first mover advantage and are already having strategic partnerships. You look at Rocky.ca that has that partnership with the Toronto Raptors right now. Fans of that team will generally gravitate towards the Rocky.ca through that partnership rather than the HIMS and HERS offerings that are now available to them. So let's see how that pans out. And critics argue that the current street expectations for margin expansions, that is the biggest bull in the place that only had a 14% upside, 14.5% upside, is actually overly optimistic. And they believe that the retail investors are, I guess we could say, over their skis in a sense with these types of pressure that we're seeing on the upside. Now, like we saw in the first graph, that over the past month, HIMS shareholders received an almost 41% return. That's phenomenal. But again, that was just because of that Novo Nordisk partnership. Analysts don't see that really panning out. I personally don't see how that's going to expand their margins and provide value long term for investors, even though we see the PE ratio on a discount. It is at a significant discount to its 5 and 10-year average. Now, I want to mention I didn't put that 5-year average on the PE ratios, but there were some cases where it was 1700 on the PE. That was when it started just to produce its earnings and so forth. So the numbers were a little bit skewed. But still, at the end of the day, valuations are stretched for the limited to almost nil growth in this name. HIMS can possibly execute on some of its international targets, whether they're able to capture more market share and able to expand margins through this partnership with Novo and expanding its offerings as well. But with all these regulatory headwinds, all these big pharma names putting pressure on all telehealth and small pharma names, I believe investors should be cautious right now in entering the name, even though shares are essentially half of what their value was, say, 8 months ago. Again, this is not investment or financial advice. It's solely for entertainment purposes. I do just want to bring this to you guys and to your attention. Please do hit that like and subscribe button. It does mean a lot to me. And stay tuned for the next video.